All right, welcome back to another edition of Financial Accounting. A couple things we want to do, a couple of announcements we want to make. Today, we're going to talk about Learning Objective 3.3. Probably won't have time to go into 3.4, 3.4, and 3.5. Will be covered on Friday to give you time to finish the homework. 3.4, 3.5 due on Sunday. We have an exam coming up in about a week and a half. That's exam number 2. If you want to review exam number 1, please do so before exam number 2. Make it a policy to not allow too much time to go beyond the exam if you want to review it. Otherwise, it creates a bottleneck for people who want to review their exams. So make sure that you review your exam during my office hours, 12 to 4, Tuesdays on between 12 and 4 p.m. If those times don't work for you, please let me know and we'll set up an appointment. I don't care if it's a Saturday or Sunday. If you need help, let me know. This material gets pretty dense after a while, so make sure that you are reading before coming to class. If you need any help, please reach out and speak to me. Make sure your notes are completed. Make sure you're getting the homework done on time, and always, always, always feel free to reach out to me when you need me. Let's talk about 3.3. 3.3 talks about adjusting journal entries. So we're going to start by recalling the Aladdin travel example from chapter 2. Remember that we created an adjusted trial balance, or UTB, as of April 30th, 2020. That was 1 month after we started on April 1st. So now it is 2 months after that end date. So imagine 3 months of business we have been involved in. And now we come to June 30th, where we see a new unadjusted trial balance as follows. We've got some cash, accounts receivable, et cetera, et cetera. Recall these balances came from the T accounts in the ledger. So we need to remember that it goes from recording journals in the journal entries in the journal to posting the effects into the ledger. Excuse me 1 second here. My sound is on. And then from the ledger, we post to the trial balance. So here we are at the trial balance. Now we need to look at our situation and ask ourselves, why do we call it an unadjusted trial balance? In other words, do we need to do anything before producing the financial statements? And the answer is yes. We assume that we must produce financial statements. We cannot assume the account balances that we see in the unadjusted trial balance are okay or accurate. The transactions may be accurately recorded, but the account balances themselves need to be checked and possibly updated. Why would the account balances be inaccurate? Well, one of the main reasons is because of the passage of time. As time goes on, we incur expenses, but maybe we don't get notified of those expenses. We just have to be aware of them. We don't necessarily need an invoice to tell us that we incurred an expense. There's also errors in communication. It's possible that we perform some services out in the field, but our consultants haven't sent us the information about what services they perform. So maybe our revenue is too low. If we've earned revenue but didn't receive the paperwork, we need to make an adjusting journal entry. How would we know that? There's lots of ways. You don't need to worry about how we would possibly know the analytics and how we could figure that out. All you need to realize is I will give you the prompts to tell you, hey, this happened. You may need to record an adjusting journal entry. Just be aware that sometimes accountants must be proactive, and we're not going to get all the information handed to us. We have to sometimes go out there and get it ourselves. Which accounts should be checked? So there are a couple accounts, different types of accounts that we need to worry about. The first one is the deferral accounts, specifically deferred expenses and deferred revenues. Deferred expenses means, when you see the word deferral, it means push. We're pushing things off into the future. So in the case of prepaid expenses, it means that cash was already paid in advance. Later, what we're pushing off is the expense to recognize. So cash moved now. And if we paid cash right now for, say, prepaid advertising, which is a current asset, we need to understand that as time goes on, it's possible that we have now an advertising expense to recognize. We have pushed or deferred the expense into the future. With revenues, it's possible that cash was received a while ago. And what we need to push off into the future is the revenue. We're pushing off revenue if we have any unearned revenue. In other words, imagine that I am the church pastor and I receive a deposit from a young couple that wants to get married 6 months from now. They pay me cash as a deposit right now. I take that cash, I put it in my bank account, but I recognize a liability called unearned revenue. As time goes by, I may have to recognize that revenue when I perform the services. So the question comes down to, has the service actually been performed and revenue been recognized? Same thing with an expense. If I prepaid for advertising a commercial, has the commercial actually occurred yet? If so, I need to recognize an expense. The idea here about deferrals is we're pushing off the revenues and expenses into the future, even though cash flows move earlier in the process. Which accounts are deferral type accounts? In the current assets area, we have supplies and we have prepaid rent. That's as far as we see it in the Aladdin example. Maybe we have prepaid insurance, maybe we have prepaid advertising. The bottom line is these accounts that we see here, cash was paid a while ago. Now we have this current asset account or these accounts. We have to ask ourselves, have these assets been consumed and therefore require some type of an expense recognition? Under liabilities, you really only see one type of deferral, and that's called unearned revenue. Unearned revenue, maybe we've earned this revenue, we don't know until we actually do some investigation. In the case of supplies, we have to ask ourselves first, what is the unadjusted balance that we see on the trial balance? So if we go to the UTB and we see that there's a debit balance of 700, we might want to ask ourselves how it got there first. That might give us an idea about whether or not we need to make an adjustment. If we go back into the journal, we see on June 2nd, we paid for supplies with cash, and that's how we got the $700, paid cash for supplies. That was a month ago. We got supplies then. What's the supplies closet look like now? If we look at the supplies closet and we do a physical count to see how much we have on hand physically, and we see that there's 400 of supplies left, that implies that 300 of the 700 was consumed. That's why we have 400. So what we need to do is reflect that consumption by way of recording a supplies expense of $300. We then also need to reduce the supplies account, that's a current asset account. We need to credit that account by 300. Does that make sense? Well, when you post it, you can see that the supplies account, when we credit that account, reduces the balance down to 400. And guess what? That represents how much we physically have in the supplies account. That's one way of doing our adjusting journal entries for deferrals. Another one is to look at prepaid rent. What is the unadjusted balance in the prepaid rent account? It's $3,000. Let's ask ourselves how it got there to begin with. When we look at the back of the journal, we see about 30 days ago, we had paid cash in the amount of $3,000 for 3 months worth of rent. That means for June, July, and August. So the question we have now is, does the balance in the account need to be adjusted? Well, June is done. So of the 3 months we prepaid, 1 month was consumed. Therefore, we need to recognize $1,000 of rent expense. So down below, we're going to debit rent expense for that $1,000, and we're going to reduce the prepaid rent account by $1,000. When we post the effects of that journal entry to the ledger, we see that prepaid rent now has a $2,000 balance. That $2,000 balance represents 2 more months of rental space available to us for July and August. In the case of adjusting journal entries for unearned revenue, remember, that's really the only deferral account for liabilities is unearned revenue. Realize that we got cash early. Now we have to ask ourselves, did we actually earn that money? Because people put money down doesn't mean we've earned it. We may have to pay that money back if we can't perform the service. So first, what is the unadjusted balance that we see? Unearned revenue has a credit balance of 400. How did it get there? Might be worth looking back 15 days ago, about 2 weeks ago. We got cash from a customer. They paid in advance $400. I owe that cash back to them if I don't perform the service. But so in that case, I will record what's called an unearned service revenue balance. That's a liability. Don't let the revenue name fool you. That's the only type of account where you see the word revenue. That's actually a balance sheet account, not an income statement account. So I have this liability of 400, meaning that I owe services, I owe effort, or I owe the cash back. Does the balance need to be updated? Well, this is the type of information I would give you to let you know that something needs to be recorded. Per the records, we've earned half of that money. So we got the cash of 400. We can say that we have earned that 200 of it. So let's go ahead and record $200 as service revenue. When we do that, we would credit service revenue. We're always crediting revenue accounts, debiting expense accounts. And as a result, we're going to reduce the liability account with a debit. Debits make me happy because I pay off debt. Debits make me happy because I get assets. So I like debits a lot. So I'm going to reduce that liability account by 200, recognize revenue. What happens as a result of that? When I post the debit to the unearned service revenue account, I can see it goes from 400 down to 200, meaning that I still owe either $200 of service or I need to pay back the $200 cash to the customer. What other accounts should be checked? Well, we've got deferral accounts and we've got accrual accounts, specifically accrued revenue accounts and accrued expense accounts. In the case of accrued revenue accounts, realize that the revenue was already recognized. Later on, we're going to recognize cash in when customers pay us. So the idea here is by bringing it back, we're going to pull. We're essentially pulling this direction. Accruing means pulling in. We're going to accrue. We're going to pull in the recognition of the revenue right now. And in the future, we'll get the cash, but we don't want to have to wait around to get the cash in order to recognize the revenue. Same thing with expenses. Eventually, I may have to pay cash out for things like employee wages or utilities. But right now, I may have to accrue the expense. I'm pulling in or accruing that expense now, even though I might pay later. So in the case of accrued revenue, what type of an account would we see for that? Any type of a receivable. Generally, accounts receivable is what we use a lot in accounting. So the question I have is, if I recognize the revenue already, it means that I've debited accounts receivable and credited revenue. That's what was already done. So now I'm asking myself, have I received the cash yet? And maybe it's not really about reducing accounts receivable for receiving cash. Maybe it's about whether or not that accounts receivable balance is high enough. It's possible that some services were performed, but I haven't recorded that revenue yet. So there may be an increase or decrease, some type of an adjustment up or down that I need to do with accounts receivable. But the bottom line is this: if I see a balance, I need to ask myself, does it need to be adjusted up or down? In the case of salaries payable, if I see a salaries payable balance, I may want to ask myself, have I paid the employees yet? They would probably riot if I hadn't. So if I see any type of accrual, I'm saying that I've accrued or pulled in some type of revenue already or expense already. The question now is, has the cash actually moved outwards? What type of accounts are accruals? Generally speaking, accounts receivable for current assets and any type of payable account for liabilities. We can see that there's an accounts receivable and there's an accounts payable on the books for Aladdin Travel. What you don't see in here, which we'll have to take a look at later, is we don't see a salaries or salary payable. We also don't see a taxes payable. We also don't see any type of utilities payable. That might be something we want to consider later on. But right now, I see two payables. I want to look and see if I want to at least consider whether or not I need to adjust those up or down. So in the case of accounts receivable, let's ask ourselves, what is the unadjusted balance currently? 2,200. How did it get there? Various sales on accounts. Again, it would be debit accounts receivable. We might look back in our journal and see several different journal entries where there's a debit to accounts receivable and credit to revenue. And perhaps we've collected cash on some of those so far, but currently people still owe us 2,200. Does that balance need to be updated? Well, assume the information I give you is that we are owed half of a $600 commission fee, meaning that we've earned $300 based on the service we provided, but we just didn't get the paperwork yet. So in this case, it's not really about the cash. It's really about, hey, have we earned any revenue but haven't recorded it yet? It's possible, in which case here we need to increase our accounts receivable for services that were performed but have not yet been recorded. So if we're worried about now, it's also possible that accounts receivable needs to be adjusted downward if there's a check from a customer lying around in someone's desk that I haven't recorded yet. Either way, realize that adjusting journal entries like these have to be adjusted upwards or downwards. Accounts receivable, when we record that, increases the balance to 2,500. There's the service revenue we need to record. What about accounts payable? In the case of accounts payable, we see that there's a balance of $13,100. Now, typically, the thing you need to understand about accounts payable is we're going to use that account a lot for any type of recurring purchases, such as inventory. And oftentimes, we'll pay that off on a regular basis. So it's possible that the amount we see, the 13,100, it's a fairly recent balance that has been accrued. So right now, let's go ahead and assume that there's no adjustments that need to happen for accounts payable. In chapter 6 and 8, we'll talk about accounts payable in general, and we'll specifically talk about what's called a subsidiary ledger. It's like taking the T account and breaking it down into smaller and smaller T accounts. These smaller T accounts will show us who we owe, how much, and how long the balances have been outstanding. So for right now, just put that in the back of your mind. We'll come back to accounts payable later in the term. What about other payables? So it's possible that we have other payables, but there's zero balance. And recall from the unadjusted trial balance that there were no line items on the unadjusted trial balance for salary payable or income tax payable. There was an unearned revenue, we dealt with that already, but it leads us to ask ourselves, do we potentially need to have a line item and an account balance for these payables that we don't see on the unadjusted trial balance? Key thing here is, what am I missing? One way to figure out whether or not you owe a payable is to look at the expenses. If we look at the expenses on the unadjusted trial balance, we can see that there's a salary expense. Well, that's neat. That means we have employees who work for us. Being that we've already paid them $900 in cash and recognized the expense, I may want to ask myself, have employees been paid yet for any recent work that they've done? This represents past services, but is there any amount of current services that employees have performed that I need to pay for? If so, I need to accrue a payable for that. Utilities expense, there's a $500 expense there. I paid that in cash. But time has gone by. Do I owe any for current utilities that have been consumed? You don't have to worry about trying to guess this stuff. I will simply tell you what the utilities accrual needs to be. You just need to know the journal entry. But it's worth noting that accountants need to run some analytics to figure out, hey, if I have a salary expense, do I need a salary payable? And always, there's some kind of tax payable that needs to be accrued for. In the case of salaries payable, I ask myself, does there need to be a balance at all? There's zero balance currently. That's why we didn't see any line item in the trial balance. It's a zero balance. Do we need to update that to some amount? Based on the information I would give you on the exam, I would tell you that salaries owed currently are for the second half of June's $1,800 total salaries. That means in the month of June, half the salaries have been paid, but there's another amount, another half that needs to be paid out. And let's just go ahead and assume that the June set, currently we're at 6/30, and we're going to pay this last 2 weeks of salaries on July 1st. The problem with that is we need to produce financial statements as of 6/30. So even though I haven't paid them yet, but I will pay them tomorrow, I need to accrue for that expense right now, because that represents the 2 weeks of work that my employees have done that I have not yet recorded as an expense. So I will record the other half, the $900, as an expense. And given that I haven't paid anything out in cash, I'm going to go ahead and credit the salary payable account. Remember, even if we pay employees tomorrow, we need to accrue as of today. And the reason why is because we're producing financial statements as of the end of today. All accounts need to be up to date. Taxes payable. There's always taxes. I'll just give you information usually about what the tax amount is. You just need to know that an expense for taxes needs to be accrued. And if it hasn't been paid yet, we'll just go ahead and credit the payable account. Which other accounts need to be checked? We talked about accruals, we talked about deferrals. Now let's talk about depreciation. Depreciation expense, technically also a deferral type of an account in the sense that we pay cash first and we expense later. So if we buy a computer, we pay now for that computer. But as time goes on, periodically we have to record an expense for the amount of wear and tear that occurs as we use the computer. We won't expense the whole thing at one point in the future. We'll do it little by little by little. That being the case, it's kind of like a deferral, but we're essentially spreading out the expense, not taking it all one chunk. It requires the use of a contra asset account. And I don't want to freak you out about that. But a contra asset account is an account that acts contrary or contradicts the behavior of a normal asset account. So what would the behavior be of a contra asset account? It would have a normal credit balance instead of a debit balance. We're going to use that contra asset account to record all the theoretical wear and tear of our computer, all of our equipment, whatever. We don't really know the actual wear and tear, but we do know this. We cannot directly reduce the equipment account because the equipment account is not disappearing the way supplies disappear. We can't say the equipment is disappearing the way that prepaid rent is disappearing. So what we need to do is simply say, we know that the value is decreasing because of wear and tear. So we're going to set up a contra account called accumulated depreciation to record the theoretical wear and tear. That currently is not in the trial balance, but it would show up right below the equipment account. Depreciation. Ask yourself, there's zero balance. Should there be a balance in there? If we've used the equipment, then there has definitely been some wear and tear. We don't want to reduce the equipment account directly. So how do we reduce it with a contra account? Well, whatever balance we put in there will be offset with the cost account. You'll see that in a second here. So down below, assume the equipment was purchased on June 3rd for $24,000. It has a 5-year life, no salvage value, meaning we'll just dump it when we're done with it. So approximately $4,800 a year of wear and tear is going to happen to the equipment. Given that's the case, what's 1 month or 1/12th's worth of depreciation? Well, that would be $400. So in the month of June, we've used the equipment. Let's go ahead and record depreciation expense for $400, representing 1 month's worth of wear and tear. And let's record the accumulated depreciation account, $400. Don't reduce the equipment count directly, leave that alone. You'll see that the equipment account will maintain its $24,000 balance. And when we produce our financial statements, we will net this debit with this credit to produce what's called a net book value. In this case, it will be $23,600. The 24,000 minus the 400 gets me 23,600. That represents because we see the 24,000 decrease down by $400, we can see now that we have future economic benefit of 23,600. Why use a contra asset account? Well, realize that the contra account represents the theoretical wear and tear over time. So this accumulated depreciation account, we'll put $400 in it for the month of June, and maybe in July we'll do the same thing, and so on and so forth each month. That just represents the theoretical amount of value that we have lost from wear and tear. Chapter 7 will discuss this in more detail, but if we want to look to see how it's represented in the balance sheet, realize that land is not depreciated. We'll leave that one alone. For anything that does depreciate, like equipment, we're going to put it off into a left-hand column for the amount of cost. And then right below it, we'll say less the theoretical wear and tear. This is all theoretical. And that will be 400 right now. This balance will increase over time, which will over time decrease the net book value. We do not depreciate land. So what do all the adjusting journal entries look like when all is said and done? Well, we would look inside our journal entry and we can see all these different journal entries, realize that again, our job in the journal is to say, dear diary, this is what happened today. So prepaid rent expired of 1,000. How do we record that in an accounting journal? We would use accounts and amounts. Now, notice how each one of these has a little tick mark next to it. That'll be useful to help us keep track of how we post it into the ledger. So down in the ledger, where we see all the different T accounts, there's the A, there's the B, there's the C. We're recognizing in the first three adjusting journal entries the resources that have been consumed. We know, for instance, that supplies have been consumed. That's why we see $300 worth of expense. Supplies have been reduced. Now they're down to $400. Rent was $3,000. We consumed $1,000 of it. Now we have $2,000 left. Equipment was used. The wear and tear represents its consumption. Now the overall balance has gone down to $23,600. What about other types of expenses that have arisen? Well, there's the salary expense, which we did incur, but we didn't pay in cash. We need to acknowledge that we now have, we had to accrue a liability because of that expense. Same thing with taxes. We use the government's resources and benefits and infrastructure. We haven't paid them yet, so we owe that money as a payable. What about any effort that's been given? Well, we acknowledge that there was that $300 worth of revenue that we earned on that commission fee that we had not yet recorded. We recorded that and we're acknowledging, oh, it's not been paid in cash. It's now a receivable. Remember that assets represent resources. So this is a new resource that we are bringing onto the books because of adjusting journal entries. Also notice that we provided effort in exchange for debt relief. Unearned revenue has decreased. That was a liability. Remember, initially when people pay us cash of $400, if we haven't earned it yet, it needs to show up as unearned revenue, the liability. If we don't perform services, we need to give that cash back to them. But once we perform all of the services, the revenue will be recognized when we debit the unearned revenue and credit the revenue account. Until then, I look at that $400 and say, I might want to put that off to the side to show that's restricted. Either way, I promise to perform the services. I'm going to do that. Effort given results in debt relief. Now what we want to do is import or input the effects of the adjusting journal entries into the adjustments column of the trial balance. Remember, this is UTB over here. We want to record the adjusting journal entry effects in the middle two columns. Don't get these mixed up. So go down the list. Accounts receivable, was that updated? It certainly was. Go inside the T account from the ledger and input that change in the appropriate column. In this case, accounts receivable was debited, so we want to transcribe that in the debit column under the adjustments heading. Same thing with revenue. Revenue was credited. Let's transcribe that under the credit heading. Supplies was credited. Transcribe that over into the credit heading. Recognize supplies expense under the debit heading. It seems pretty simple, but it's easy to make a mistake. Prepaid rent was consumed. Input that under the credit heading. Rent expense, put that under the debit heading. Accumulated depreciation, make sure you're very careful about this. We don't want to directly reduce the asset account equipment itself. And especially when we're dealing with contra asset accounts, it's easy to get carried away and accidentally put it in the debit column when it really belongs in the credit column. So just be careful. Depreciation expense is inputted under the debit heading. Salaries payable, that was a line item we didn't have. We had to stretch out our spreadsheet and input that sucker in there and recognize the salary expense. Unearned revenue was updated. Make sure you're very careful with that. It's a credit balance because it's a liability. We reduce that liability with a debit, recognize the revenue with a credit. Income taxes payable, that was also a new line item. We had to create that and show the fact that we owed $600 because we consumed the benefit of the government's resources. After we've done all that, we want to do what's called crossfoot, which is adding across the amounts. And this is the process. Ultimately, the adjusted trial balance columns are what we want to use to create the financial statements. To get the balances over on the far right-hand side, we need to add from left to right. So we'll start with the cash account. Notice that it starts off with a debit balance of 36,800. We want to go over to the adjustments column and ask ourselves, was anything debited to increase it or credited to decrease it? Nothing was changed here, so we're just going to bring over the full 36,800. What about accounts receivable? It's a debit balance. Did it change? It did. There was a debit of $300. So that increases, that debit plus the original debit results in a new debit balance of $2,500. Go down to supplies. $700 debit. Did it change? There was no increase, there was only a decrease. So we want to be careful, make sure that we're subtracting 300 from 700 to get us the 400. And on we go. Again, it seems like a pretty simple exercise, and it is, but it's easy to make a mistake. Bottom line is make sure that your total debits equal total credits as you go through. Once you've done that, and you have this glorious looking adjusted trial balance, guess what? You're almost done. You can use this right now to produce financial statements, but my recommendation is just go back and spot check a few balances. We know the accounts receivable balance per the ATB is $2,500. It may be worthwhile to go back into the ledger and check to see if the balance $2,500 actually exists. It does. It means we've done that right. What about salaries payable? Salaries payable has a $900 balance on the ATB. It has a $900 balance in the T account. Again, it's just good to go back and spot check these things. Notice we still have the debits equal the credits, right? How might we want to use that when we look at the trial balance overall? I don't recommend you do this. It's a lot of work. But you could go back into the ledger and add up all the debit balances. And if you did, you would come up with a total of 91,500. Do the same thing with all the credit balances. 91,500 generally means that you've done it right. Bottom line is here, we need to do these adjusting journal entries to update, if anything, our revenue and expense accounts. So when you're doing any type of adjusting journal entries, remember, you're going to be affecting at least one balance sheet account and at least one income statement account, which is why we see so many adjustments to the expenses, and to the revenue account. But you kind of see now that expenses are primarily just filling up with debits, revenue is primarily just filling up with credits. We're going to empty those out later on when we close the books, which we'll talk about in 3.5. But right now, here's a little preview. We're going to take all the information from our adjusted trial balance and produce financial statements, a lot like we did in 2.5. So what you'll read about in 3.4 will look familiar. We're going to do the same thing we did in 2.5, but we're going to be using the adjusted trial balance column. That's it for now. If you have any questions, please let me know.